In the past lessons, we have already covered some of the strongest foundations of trading: support, resistance, trend lines, candlesticks, moving averages, and how price actually moves. But today we are adding something that most traders ignore, and that's volume. Volume is one of the most powerful confirmations in trading, yet it doesn't get the respect it deserves. The truth is, when you understand volume properly, and especially when you combine it with price action, your entries, exits, and confidence instantly level up. Now, I'm going to be honest with you. This lesson is going to be long, not because I want to overwhelm you, but because I am covering everything about volume in one place. So you don't have to keep searching, guessing, or learning the wrong way. Before we dive in, let's take a quick look at what we learned today so you know exactly what's coming. What volume really is, why volume matters, how to read and interpret volume properly, common mistakes traders make, volume and price action relationship, color misconception, timing of volume, how time frames change volume interpretation, breakout volume versus distribution volume, volume in trends versus volume in ranges, comparing current volume versus previous volume, multi-time frame volume confirmation, volume as a pre-breakout signal. By the end of this lesson, you will not only understand what volume is and why it matters, you will know how to use it to confirm trends, avoid fake breakouts, and spot reversal points before most traders even notice. If you follow along and pay attention, this will give you a real edge that most people overlook. All right, let's get started. So what's volume? Let's slow it down and really answer the question. What exactly is volume? At its core, volume simply tells us how much trading activity is happening in the market during a specific period of time, whether that's 1 minute, 1 hour, or 1 day. But the meaning of volume can change slightly depending on the market you're trading. In stocks, volume represents the number of shares traded. For example, if Apple has a daily volume of 50 million, that means 50 million shares of Apple stock were bought and sold during that day. The higher the volume, the more active and liquid that stock is. In crypto, volume shows the number of coins or tokens traded. So if Bitcoin has a volume of 100,000 BTC in a 24-hour period, that's how much Bitcoin has exchanged hands across the market. Crypto traders especially watch volume because it can confirm whether a big price move is real or just a short-term spike. In Forex, things are a little different. Since Forex is a decentralized market, there is no exact record of how many units of a currency pair are traded. Instead, brokers show tick volume, basically how many times the price changes within a period. And even though it's not the exact number of contracts traded, tick volume still gives us a reliable picture of activity and interest in the currency pair. So no matter what market you are in, stocks, crypto, or Forex, volume is a measure of participation and interest. And when you combine that with price, it becomes one of the most powerful ways to confirm whether a move is strong and trustworthy. So let's see why volume matters. Now that we know what volume is, let's talk about why it actually matters so much in trading. First, volume confirms the strength of price movements. For example, if a stock breaks out above resistance and the volume is high, that tells us there are a lot of buyers supporting the move. On the other hand, if price breaks out but the volume is weak, that breakout is more likely to fail because there's not enough participation to push it further. Second, volume helps us separate real breakouts from fake ones. You have probably seen this before. Price shoots above a key level, looks like it's about to explode, and then it collapses right back down. That's often a fake breakout. And low volume is usually the clue. Real moves are backed by strong volume. Fake moves usually aren't. And third, volume reveals the supply and demand dynamics in the market. If demand, which means buyers, is strong, we will see rising prices supported by rising volume. If supply, that means sellers, is stronger, we'll see falling prices on high volume. By paying attention to this, we can actually understand the story behind the candles. Who is in control, buyers or sellers? So volume is not just a number at the bottom of your chart. It's the heartbeat of the market. Now let's see how to read volume. I'll break this into 4 clear use cases you will use over and over: trends, breakouts, spikes, and dry ups. For each one, I'll explain what to look for, why it matters, and one practical way to trade or avoid mistakes. So the first one, trends. Read volume to judge trends. First, trends. Volume tells you whether a trend has a real support. When price is trending up, the healthiest uptrends show strong volume on the impulse legs and lighter volumes on the pullbacks. That pattern means buyers push price up and sellers don't fight aggressively on the retraces. Conversely, a healthy downtrend shows high volume on down impulses and lower volume on bounces. A red flag, price making higher highs while volume trends down. That's a warning that fewer traders are supporting the move. The trend may be weakening and vulnerable to reversal. Compare the current candle's volume to the recent average. For example, a 10 to 20 period moving average of volume. If the impulse candle has volume well above the average, the move has conviction. In a confirmed uptrend, prefer entries on pullbacks when volume is low. You're buying when sellers are quiet. Use the trend volume to bias direction and tighten risk. Next, breakouts. A breakout isn't validated until volume helps confirm it. A real breakout typically occurs with a significant spike in volume. Buyers or sellers step in aggressively and create follow-through. A fake breakout often displays little or no volume increase. Price pokes above resistance, but lacks participants to continue. It often reverses. Look for the breakout candle's volume to be meaningfully larger than the recent baseline. Many traders use 2 times, 3 times the recent average as a guideline, but this depends on the instrument's normal activity. A strong breakout often retests the breakout level on lower opposite volume and then continues in the breakout direction. If the retest shows heavy opposite side volume, the breakout is being rejected. Wait for either A, the initial breakout with high volume and trade with a tight stop under the breakout, or B, a successful retest with low opposing volume and enter on confirmation. Now let's see volume spikes. Huge volume can mean all in and often precedes a reversal. A volume spike or climax is when a single bar shows extremely high volume compared to everything around it. These often appears at tops or bottoms. At a blow-off top, you might see a huge green candle with a massive volume and a long wick. That can be the final frenzy of buyers. Similarly, at a selling climax, you often see a panic down candle with massive volume. Why it signals exhaustion? The last buyers or sellers often transact with maximum force. After they are done, there are fewer participants left to keep moving price in the same direction. How to trade it? Treat climaxes as contrarian signals, but wait for confirmation. Example, a structure break back inside the range or a confirming reversal candle with lower follow-up volume. Don't jump in immediately just because volume spiked. So if you see a giant top volume candle, wait for a break of the low of that candle, or for a bearish price action with falling volume confirming the change in control. Finally, dry ups. Low volume often precedes big, fast moves. A dry up is when volume steadily decreases during a contraction or consolidation. It's common in accumulation phases or during volatility contraction patterns. Low volume means less liquidity, so when a breakout finally arrives, it can move fast because there are fewer orders to absorb the move. This pattern is not a guarantee. Low volume can also mean disinterest and a long time of chop. The context matters. Are you seeing narrowing price range plus decrease in volume? That's more meaningful. How to use it? Watch for decreasing volume during volatility contraction. When price eventually breaks, check for a volume pickup on the breakout. If breakout comes with a volume spike, odds favor a strong follow-through. So be cautious. Thin volume environments, that means pre-market, after hours, small cap stocks, some altcoins, can produce misleading signals. Always check relative volume versus normal trading hours. Here's a quick checklist I use every time I glance at volume. Compare the candle's volume at the recent average, 10 to 20 period moving averages. Check the color of the volume bar, green on bullish candles, red on bearish, and ask who is driving the move. Ask whether volume matches price direction. Convergence is equal to healthy. Divergence means warning. Look for spikes at possible turning points and dry-ups during consolidation. Confirm on a higher time frame if the trade is significant. Higher time frame volume adds weight. Always consider news or events. Sometimes the spike is just an external catalyst and requires a different approach. Final practical tips. Use relative volume or a moving average of volume rather than absolute numbers. 2 times average is useful only if you first define the average. For Forex, remember you're looking at tick volume. Treat it similarly, but be aware it's a proxy. Combine volume with your price action rules. Volume alone is not a full system. Practice on charts. Pick a trend. Identify impulse versus pullback candles and mark where the volume agrees or disagrees. So mastering volume reading takes practice, but once you start checking these 4 situations every time you trade, you will spot better entries and avoid a lot of bad trades. Now that you understand how to read volume, let's talk about the biggest mistakes traders make when using it. A lot of people misunderstand volume, and that leads to bad entries, early exits, or getting trapped in fake setups. So let's break down the 3 most common errors. Trading based on volume alone. One of the biggest mistakes is thinking volume by itself is enough to take trades. Volume is powerful, but it always needs context. For example, just because you see a spikes in volume doesn't mean you should enter the trade. The market could be reacting to news, stop hunts, or liquidity grabs. If you don't combine volume with structure, support, resistance, trend, or price action, you are guessing, not trading. Volume is like a translator, not the decision maker. It tells you what's happening behind the scenes, but the chart still needs to confirm the story. Ignoring relative volume. Another huge mistake is looking at volume bars without comparing them to the stock's normal volume behavior. This is where traders go wrong. A volume bar of 1 million might look big, but if the average is 5 million, that's actually low. A small stock trading 200,000 shares a day could see 800,000, and that's a massive increase. So instead of looking at volume in isolation, compare it to the average or relative volume. Tools like relative volume on platforms like TradingView or Thinkorswim help you see if today's activity is abnormal or just average noise. Without relative context, you might misjudge a breakout, enter late, or miss major moves. Misreading random spikes without context. This is probably the most dangerous one. New traders often see a tall volume bar and assume something important is happening. But not all spikes matter. Some are just institutional rebalancing, stop-loss sweeps, end-of-day adjustments, one-time transactions. If you don't connect the volume spike to price action, levels, trends, or news, you might completely misinterpret the move. For example, a spike near resistance with no breakout equals rejection or trap. A spike in the middle of a range is noise. A spike after a huge move is often exhaustion, not continuation. So always ask yourself, did price follow through? Is the spike happening at a key level? Is it a trend or in a range? Is it part of accumulation or distribution, or just a random candle? When volume and price don't align, it's a warning, not a signal. All right, now let's bring everything together. Because volume alone is powerful, but volume combined with price action is where the real edge shows up. Volume is the activity behind price. Every candle you see on the chart is the result of buying and selling, and volume tells you how real or meaningful that move is. A price action on low volume can be weak, temporary, or even manipulated. But when price moves with rising volume, that tells you real participants, traders, institutions, algorithms are stepping in with conviction. Why you combine volume with price action, support, resistance, and candlesticks? Volume becomes 10 times more powerful when you pair it with what price is actually doing. If price breaks above resistance with strong volume, that's a legit breakout. If it breaks a key level on weak or average volume, be cautious. That move can easily fail or retest. When a candlestick pattern shows up, like a hammer, doji, shooting star, or engulfing candle, and volume supports it, the setup is way more reliable. Think of it this way. Support and resistance tell you where price matters. Volume tells you how strong the move is at that level. Volume helps confirm strength, breakouts, and turning points. Here's how volume confirms different price situations. Trend strength, increasing volume means the trend is healthy. Decreasing volume, momentum might be fading. Breakouts and breakdowns. If a breakout happens with strong volume, it's more likely to continue. If it happens on low volume, it's more likely to fake out or pull back. Reversals or exhaustions. Volume spikes at the top or bottom of a move often signal the end, a climax, or exhaustion point. So always remember, price tells you the direction, volume tells you the conviction behind it. When you read both together, you stop guessing and start understanding what's really happening. Now let's look at real chart scenarios. Example 1, breakout with rising volume. All right, let's break this down. You will often see price moving sideways, just consolidating inside a range. Nothing crazy. Then suddenly a candle finally closes above that resistance level. Now here's the key part. As soon as that breakout happens, look at the volume. The bars start increasing, sometimes doubling compared to the previous candles. So what does that tell us? This isn't just a random move caused by a few traders. When volume expands during a breakout, that means real buyers are stepping in. There's conviction behind the move. How to trade it? You can enter on the breakout itself or even wait for a little pullback. Ideally, a low volume retest and place your stop just below that level. And always compare volume to recent candles. If the breakout happens with 2 times or 3 times the usual volume, that's strong confirmation. Now let's look at example 2. Volume spike at the top, exhaustion or reversal. Look at opposite situation, a climax. Price pushes up strongly and you see a big candle or maybe a candle with a long wick at the top. But the interesting part is what's happening underneath. There's a sudden volume spike, a bar way larger than the previous one. So what does that mean for you? That's often exhaustion. Think of it like the final push. Late buyers jumping in and early buyers taking profits at the same time. After that kind of spike, there's usually isn't enough fuel left to keep the move going. So the takeaway here is don't chase that last push higher. Instead, wait for confirmation, like a break of that candle's low or clear bearish follow through, and look for a possible reversal or fade back into the range. All right, now let's look at example 3, low volume accumulation before breakout. This is a very common setup you will see a lot. Price is sitting in a tight range near support. The candles are small, the volume is dead. It looks like nothing's happening, but that low volume is actually information. It usually tells you that sellers backed off and the market is quietly accumulating. Then boom, a breakout candle forms and volume finally jumps. What does that mean? That dry period was a build-up. Traders were positioning quietly, and once buyers step in with strong volume, you get a clean breakout with follow-through. So how to trade it? When you see low volume contraction followed by a low volume surge and a breakout, that's your clue. You can enter at the breakout and place your stop under the consolidation. These kinds of moves often run nicely because there is no resistance immediately ahead. Now let's look at the next section, the biggest misconception about volume colors. A lot of traders make this mistake without even realizing it. They think a green volume bar means buyers were in control and a red volume bar means sellers were in control. But that's actually not how it works at all. Here's the truth. The color of the volume bar is based on the direction of the candle, not who was buying or selling. So for example, if the candle closes higher than it opened, the platform colors the volume bar green. If the candle closes lower, the volume bar is shown as red. That means a green volume bar does not automatically mean more buying. There can be aggressive selling inside that candle. The close just happened to be slightly higher than the previous one. The opposite is also true. A red volume bar doesn't always mean sellers are dominating. Price could dip slightly and still have strong buying activity overall. So what should you focus on instead? 2 things. the size of the volume bar. So ask yourself, is the volume higher or lower than the previous candles? Is it above average for that time of day or time frame? Is it increasing or drying up? Volume size tells you participation and conviction, not the color. Next, the price reaction. Price tells the truth. Volume just confirms it. For example, if a red candle breaks resistance without above average volume, it may still be buyer-driven aggression. If a green candle barely moves and volume is low, that bullish move means nothing. If volume spikes at support but price closes weak, that could be distribution, not buying. The key idea is you don't trade the color of the volume bar. You trade the behavior behind the bar. So stop assuming green means buyers and red means sellers. Start combining volume size with price action, candle structure, and key levels. That's when volume becomes a real edge. Now let's look at the next section. Timing of volume before, during, and after the move. Most traders only look at volume after something happens. But the timing of volume is what really tells a story. Volume can appear before the move, during the move, or after the move, and each one means something completely different. Let's break this down in a simple and practical way. Number one, volume before the move. That is accumulation or positioning. When volume increases before price makes a breakout or reversal, it's often a sign of smart money building positions quietly. Price might still look flat or range bound, but participation is rising. Now let's take an example behavior. Price is consolidating near a support or resistance level. Volume increases even though the candle range is small. That build-up can signal accumulation before an explosive move. This is where retail traders are usually asleep and professionals are getting in early. Next, volume during the move, confirmation of strength. This is the type of volume most traders focus on. When volume rises as price pushes up or down, it tells you that the move has commitment behind it. Example, breakout above resistance with strong volume. Trend continuation, candle with increasing volume. Big push from a key level backed by rising participation. When price moves and volume supports it, that's confirmation. Next, price after the move, exhaustion or reversal risk. Now here's what most people ignore. Volume that comes in after a big move, this is where you often see exhaustion, profit taking, or even traps. Let's take some scenarios. Price reaches a peak or support zone, huge volume shows up, but price barely moves anymore. Candles start wicking or losing strength. High volume after the move can mean traders closing positions, late buyers or sellers getting trapped, reversal or pullback about to start. So the takeaway from this is, don't just look at volume, look at when the volume appears. Before the move equals positioning, during the move is confirmation, and after the move, exhaustion or reversal signs. Once you start combining timing with structure, you will stop chasing fake moves and start anticipating real ones. Now let's look at time frame impact, how volume changes with each chart. One of the biggest mistakes traders make is analyzing volume on the wrong time frame and assuming it means the same thing everywhere. But the reality is this: volume is relative to the time frame you're on, and its meaning changes based on context. Let me break it down in a way that actually makes sense. First, volume on higher time frames, like daily, 4 hours, or weekly. When you look at volume on a higher time frame, you're seeing the overall conviction of the market. Strong daily volume is equal to institutional activity. Clear spikes equals major participation or news. Low volume days is actually uncertainty, waiting, and indecision. One daily candle includes thousands of trades from different sessions, so the volume has more weight and significance. Now next, volume on lower time frames like 1 hour, 15 minutes, or 5 minutes. On smaller time frames, volume tells you about short-term reactions and intraday moves. Scalpers and day traders drive these bars. Volume can spike without changing the bigger trend. Breakouts may look strong here, but weak on higher time frames. You can't treat a 5-minute breakout with the same importance as a 4-hour breakout, even if the volume looks big. Next, same move, different meaning across time frames. Here's a mistake traders make all the time. They see a breakout on the 15-minute chart with good volume and they assume it's a strong move. But on the daily chart, it's just a tiny candle inside a range with weak overall volume. And the result? Fake confidence and bad entries. You must always zoom out and compare. Does the lower time frame volume align with the higher time frame? Is the breakout visible and supported on the bigger chart? Are you reading noise or real momentum? Next, volume plus time frame equals accurate interpretation. Volume doesn't stand alone. The time frame defines its meaning. For example, a 200K volume spike on a 5-minute chart might look huge, but on the daily candle, it's nothing. It's irrelevant. So before drawing conclusions, always cross-check with a higher time frame. Use the main time frame of your strategy as reference. Don't let a small chart fool you into overreacting. Once you understand volume through time frames, you stop getting tricked by noise and you start trading what actually matters. Let's look at the next section, breakout volume versus distribution volume, and what's the difference between them. One of the biggest clues volume gives you is whether a move is starting or ending. Two of the most important types are breakout volume, which is ignition volume. This is the type of volume that signals the start of a strong move. Here's what characterizes it. Appears during or right before a breakout from support or resistance. Volume is higher than usual and increasing. Price pushes strongly in one direction, often supported by trend or structure. This kind of volume tells you buyers or sellers are stepping in aggressively. The level has been accepted. Momentum is real and can continue. If the price breaks a range or a key level with a weak volume, that's a fake out risk. Next, distribution volume, which is exhaustion or ending volume. This is the opposite. It signals the end of a move, not the beginning. Key trades appears after an extended trend, up or down. Volume spikes sharply near the top or bottom. Price stops gaining ground despite high activity. Often comes with reversal or indecision candles. This type of volume tells you big players are unloading positions, late traders are trapped, a pullback or reversal is coming soon. A lot of traders get fooled because both types show high volume, but the context is different. How to tell them apart? So let me break this down for you so you can tell the difference between breakout volume and distribution volume, because they might look similar at first, but they mean completely different things. When you see strong volume at the start of a move, that's usually breakout volume. This is where price is breaking above resistance or below support, and the volume confirms that traders are entering with momentum. That's why in the timing row, breakout volume is tagged as the start of the move. Now compare that to distribution volume. This shows up at the end of a move. Price has already made a big push and now smart money is unloading positions. That's why distribution volume appears near the top or bottom, not at the breakout. Next, look at price reaction. With breakout volume, price usually continues strongly in the direction of the move. We call that follow through, but during distribution volume, price tends to stall, wick, or reject levels because buyers are no longer pushing. Sellers or profit takers are stepping in. The last row is about trader behavior. Breakout volume is driven by entry momentum. Traders jumping in as the move begins, but distribution volume is the opposite. That's where traders are taking profits or exiting positions, which can signal that the move is running out of strength. So the key takeaway, volume at the start of a move plus strong follow through, that equals breakout volume. Volume at the end of a move plus hesitation or rejection, that equals distribution volume. This is how you avoid buying at the top and instead position yourself with conviction at the right moment. The next section, volume in trends versus ranges. Let's break one of the biggest mistakes traders make using volume the same way in every situation. Volume behaves differently when market is trending and when it's moving sideways. If you mix them up, you will misread trends, reversals, and breakouts. Now let's look at volume in an uptrend. When the market is moving up, increasing volume on green candles is a strong sign. Institutions are participating. But if price is still going up while volume keeps dropping, that's a warning. The trend might be losing fuel. But when price pulls back with low volume, that's normal. Buyers are still in control. Now let's look at volume in a downtrend. In downtrends, strong volumes on red candles confirms heavy selling. If rallies happen on a weak volume, that means buyers aren't serious. Sellers still dominate. But when you see a massive volume spike after a long decline, that could be capitulation, the final flush before a reversal. Now let's look at volume in a range, which means sideways market. A range can mean two things: accumulation or distribution. If volume builds near the bottom of the range, smart money is loading. That's accumulation and often leads to a bullish market. If volume increases near the top, that's distribution. Big players exiting before a breakdown. Low volume inside the rally simply means indecision. The move only matters when volume expands on the break. Now, when trends turn into ranges, after a strong trend, if volume stays high but price starts moving sideways, the market is pausing, either to continue or reverse. But if volume fades inside the range, it's waiting for a trigger. A breakout only matters when volume confirms it. Before reading volume, always ask one question: am I in a trend or in a range? Volume only makes sense when it's matching the market condition. Otherwise, you're guessing. Compare volume, don't read it blindly. One of the biggest mistakes traders make is looking at a volume bar and trying to guess what it means by itself. That doesn't work. Volume only has meaning when you compare it to what happened before. We'll look at 4 types of comparisons, and then I will tell you exactly what to watch for. Current volume versus the previous candle. One of the easiest comparisons is simply checking whether the current volume is higher or lower than the last few candles. If the current volume is higher than the last 1 to 5 candles, that tells you participation is rising. More traders are getting involved. That adds strength to the move. But if volume is lower, it usually signals weak conviction. The price might move, but there's no real force behind it. Example, if you see a breakout and the volume is higher than the last 3 to 5 candles, that's a strong, valid breakout. But if you see a big candle with low volume, stay away. That's often a fake move. Current volume versus the average volume. The second way to compare volume is by checking it against an average, like the session average or a 20 or 50 period average. If the current volume is above the average, that means strong activity. Institutions or big players are probably involved. If it's below average, the move is weak. It's not backed by enough participation. This is super important during breakouts, reversals, or pullbacks. Volume spikes versus normal activity. A lot of people see a spike in volume and assume it's a breakout signal. But spikes only mean something when you compare them to normal or baseline activity. A volume spike at support or resistance can signal a breakout or a reversal. A spike after a long move up or down can mean exhaustion, the final push before the trend ends. So don't get excited by any spike. Always ask whether is it happening and compare to what. Now, volume over multiple candles. This is one of the most powerful ways to track volume. Don't just look at a single bar, look at the trend of volume over time. Here are the most common scenarios. Rising price plus rising volume gives you trend continuation. Rising price plus falling volume means weak trend. Flat price plus rising volume actually is accumulation and distribution. Range plus low volume, market is waiting, a breakout may come but later. When you look at volume as a progression instead of a single bar, you start to understand the real story behind price movement. So here's a quick guide and a checklist you can use when reading volume. Here I will compare volume behavior versus what it means. Above average means strong participation. Below average is weak interest. Volume spike is potential breakout or reversal. Increasing volume means momentum is building. Decreasing volume, on the other hand, is trend is losing strength. So the main idea here is never read volume in isolation. Always compare it to something: the previous candle, the average, the baseline, or the recent trend. That's what tells you if a move is real, weak, or about to reverse. Let's discuss multi-time frame volume confirmation. We got to talk about something that separates amateurs from serious traders: confirming volume across multiple time frames. A lot of traders make this mistake. They see strong volume on one chart and jump into a trade. But when you check at higher time frame, there's no confirmation and the move fails. Multi-time frame volume lets you filter the noise and only trade when strength is real. Why you should check volume on more than one time frame? When you only look at volume on a single chart, you can easily get trapped. Maybe the 1 hour chart shows a breakout with strong volume, but the 4 hour chart or daily chart shows no interest at all, which means the move may be weak, temporary, or manipulated. But when you check volume across 2 or 3 time frames, you can confirm trend strength, validate breakouts, avoid fake momentum, spot institutional activity, time your entry with confidence. In short, you stop guessing, you start trading with confirmation. Best time frame combinations based on trading style. The idea is to get your setup from a smaller time frame and your confirmation from a higher one. Here's how to do it. Day traders use 5 minutes, 15 minutes, and 1 hour charts. Swing traders use 1 hour, 4 hour, and daily. Position traders usually use daily and weekly. The rule is simple. Lower time frame gives the setup, higher time frame confirms the strength. How to actually use multi-time frame volume? Let me give you 3 practical examples so this becomes more clear. Number 1, breakout confirmation. You see a breakout on the 1 hour chart with strong volume. Now you can check the 4 hour chart. If volume is also above average, that's a confirmed breakout. Much higher probability. If the 4 hour volume is weak, that's a red flag, like a fake move. Next example, trend strength. Price is trending up on the 4 hour time frame and volume keeps building. You drop down to the 1 hour chart and see a pullback with supportive volume. That means the higher time frame supports your entry, strong continuation setup. But if the higher time frame shows weak or declining volume, the move might die out. The next example, reversal setup. On the daily chart, volume spikes at a major resistance. That's a potential climax. Now look at the 4 hour chart. If you see a bearish candle with strong selling volume, that's a confirmed reversal. When volume lines up across both time frames, the move has real weight behind it. Here's a quick guide on what multi-time frame volume tells you. For a lower and higher time frame, when a breakout happens on high volume in both lower time frame and higher time frame, it means a real move. But when a breakout happens with high volume in lower time frame and low volume in higher time frame, that's a fake out risk. On a trend, if there is rising volume in lower time frame and steady rising in higher time frame, it's a strong trend. For a reversal, if you see volume spike in lower time frame and a volume spike in a higher time frame, that means high probability reversal. For range, if you see low volume in low time frame and low volume in higher time frame, stay out and wait. If both time frames agree, you have got confirmation. If they don't, then please wait. Why this gives you an edge? Using multi-time frame volume helps you filter out weak or fake moves, spot institutional participation, confirm breakouts before entering, time trend continuations and pullbacks, and finally avoid getting trapped in noise. Final takeaway, never rely on one chart when reading volume. When 2 or more time frames confirm the move, you are trading with strength, not hope. If you want high probability entries and fewer surprises, multi-time frame volume is a must. Now let's look at volume as a pre-breakout indicator. Pay close attention to this one. Before a breakout happens, the market almost always leaves clues, and one of the biggest clues is volume. Price doesn't just explode randomly. It builds pressure first, and volume is what tells you that pressure is building even before the breakout candle appears. Let me walk you through it step by step. First, what do we mean by pre-breakout volume? Pre-breakout volume is simply the volume activity that shows up before price breaks a key level, like support, resistance, a trend line, or the edge of a range. When you understand it, you can often spot the move before it happens. Here are the most common signs. Volume gradually increasing while price is consolidating. Pullbacks happen with low volume, showing there is no real selling pressure. A sudden volume boost right before the level breaks. Relative volume starts rising compared to previous candles. These are early footprints of smart money building positions. Why pre-breakout volume matters? If you only wait for the breakout volume, you are reacting late. But if you watch volume beforehand, you get a head start on the move, smaller stop loss placement, fewer fake breakouts, insight into whether institutions are involved, a read on whether momentum is building or dying. You are basically reading intention before price confirms the move. The four most common pre-breakout volume patterns are the following. Let's break these down in a way that's easy to recognize on the chart. Volume build-up during consolidation. Price might be moving sideways in a range, wedge or triangle, but volume slowly rises. For example, price is sitting near resistance. Each day, volume starts creeping higher. Buyers are quietly absorbing seller orders. That tells you pressure is building and a breakout is likely to follow. Volume drops on pullbacks. This one is powerful. If price is heading toward a key level and the pullbacks are happening on low volume, that tells you sellers are weak. Example, market is in an uptrend. Small pullback forms. Volume drops during the pullback, then volume picks up again. This usually signals bullish continuation and a possible breakout soon. Let's look at hidden accumulation or distribution. Price stays tight, doesn't move much, but volume starts rising quietly. What's happening? Institutions are positioning before the move. You will often see tight candles, no dramatic price actions, but volume increasing. Then suddenly, boom, price breaks with strong volume. This is the loading phase before the move. Now, volume spike right before the break. Sometimes you will just see one or two large volume bars right before the breakout. For example, price is sitting near resistance or support. A big volume bar shows up out of nowhere, but price hasn't broken yet. That's early entry from big players. These moves often explode immediately after. Now, how do you spot real breakouts versus fake breakouts? So for real breakout, the volume builds up before the move, whereas for fake breakouts, the volume flat or declining. Similarly, for real breakouts, pullbacks are low volume, whereas for fake breakouts, pullbacks show normal volume. For real breakouts, volume spikes are near level, whereas for fake breakouts, volume only increases after the break. And candles tighten before breakout in real breakouts, whereas for fake breakouts, price looks choppy or unstable. If there's no fuel, the move won't last. So now, how do we actually use this in trading? Let me break it down in a simple, practical way. First, before a breakout happens, you want to pay attention to how volume behaves during consolidation or compression. If price is stuck in a range or forming a triangle, don't just watch the candles. Watch what volume is doing behind the scenes. Next, compare volume to the average. I like to use relative volume for this. It tells you instantly if trading actually is increasing or the move is weak and random. If volume is rising above average before the breakout, that's a strong clue. Then align it with the overall trend. If we are in an upward trend, you notice volume rising before price hits a resistance level. That's usually a continuation setup. If price is in a sideways range and volume starts building, that tells you the market is getting ready to expand, either up or down. Now, what should you completely avoid? Breakouts with weak or low volume behind them. Sudden price spikes that don't have any volume support. Those are the classic fake out traps. Let's wrap it up with the key takeaways. And here's what I want you to remember. Volume very often gives a signal before price breaks a level. Breakouts that show volume buildup beforehand are way more reliable. Most fake breakouts happen when volume is flat or even declining. The best entries come when you combine three things together: structure, trend, and pre-breakout volume. And once you start recognizing this, you will stop chasing moves late and start positioning early, just like the pros do. Now you understand how volume reveals real momentum, fake moves, breakout pressure, and trend conviction. Get ready, the RSI and MACD lesson is next, and it will connect perfectly with everything you have learned so far. If you found this valuable, don't forget to like the video and subscribe to the channel so you don't miss the next lesson.